Hello, Steve Vanderway here, and we're going to talk about the story of investing, and we're going to use the three-factor model that Eugene Fama gave us. The three factors, if you remember, is one, you have to be in the markets to get market returns. That's you need to own stocks. The second factor is the size factor, and then the price factor. Those are the three factors. We're going to talk about that. Eugene Fama tells a story, and I'll tell you right now, the story has a happy ending for disciplined investors. And Eugene Fama not just told the story, he proved the story to be true with science and academics. And the results of that are what we're going to look at here briefly. So the first factor was own stocks and stay in the market. You can't get market returns if you're not in the market. A lot of people are jumping out of the market right now because they're scared. That's not a good that's not a good strategy, and it doesn't end well when you do that. The second factor is the size factor and then the price factor. The size factor is large and small. We know intuitively that small is riskier than large. Well, Eugene Fama proved that small is riskier, and the market pays for that additional risk with higher returns in small than large companies. Same with growth and value companies. If you want to know what that is, think of a pretty house and an ugly house on the same street. The value company is the ugly house. You want to live in the growth in the pretty house, but the value house, you know, from an investing standpoint, can get you a better return because you can oftentimes buy it for less and get more growth. So when you look at returns in the market, we know, and Eugene Fama proved that large growth companies lower returns over time. Small value companies provide higher returns over time. And then there's large value and small growth companies as well. And when we look at the actual returns, large companies gross of any fees are 10%, 12, and 14%. The returns are higher on the small value, and that's why the free market funds are tilted towards small value. Now, this isn't true every year, and it certainly wasn't true the last 5 years, but over time it proves true, and we're long-term investors for long-term dollars. Small value is where you win. And so looking at it from a long-term basis, you see that U.S. large, this is the S&P 500, 10%, and then a large value, and then small value, that's further on the end, and then same thing, large and small value is same for the international. In fact, it proves true in every market. So it's not just the U.S., but the international markets in every market that they look at. The size and the value, the size and the price factor exist, and you want to own those, and you do, so you have reasons to be encouraged. This is what it looks like for a disciplined investor over a 25-year period of time. Look what the returns are for somebody that invested $100,000 in 1992. Returned $672 net of fees. This is what would end up in your account. At the end of 2017, at the end of 2018, it's down a little bit. It's closer to 600,000, but that's okay. 100 to 600,000 is a generous return. The markets are generous when you stay disciplined. So the problem is these ups and downs. We're in one of these right now, and that's a problem if you can't understand how that works. And you need to stay disciplined during these periods of time. The solution is to get to a 2-day workshop and understand why it's so hard to do this. So few people get these returns because so few people have the capacity to stay disciplined during these market volatility times. There's reasons why that is. You can understand what those are. Come join us. We'd love to have you there. Thank you.